You're sitting at the kitchen table late in the evening, not in a dramatic way. Just one of those quiet moments after the day has already taken most of your energy. There's a glass of something next to you. The house is finally still, and you're looking at numbers that represent years of effort. You imagine what it would feel like to be done, to send one last payment, to know that no bank owns a piece of your life anymore, no monthly reminder, no balance hanging over your head, just finished. For a lot of people, that image feels like the ultimate version of financial peace. Paying off the house, owning it free and clear, being able to say, no matter what happens, at least I have this. And I get why that idea is so powerful. I really do. But I want to sit with that feeling for a moment, because what sounds like security on paper doesn't always behave like security in real life. And the reason so much financial advice feels obvious but falls apart when people try to live it is that it often confuses emotional comfort with actual resilience. Let's rewind and look at this more honestly. Most people grow up absorbing one very clear message about money. Debt is dangerous. Debt means risk. Debt means stress. And the ultimate goal is to reach zero. Zero payments. Zero balances. Zero obligations. That belief didn't come out of nowhere. It came from generations that lived through very different economic realities. Times when interest rates were brutal, when credit was unstable, when a single loan could quietly destroy a family. In that world, getting out of debt wasn't just smart. It was survival. But we don't live in that same math anymore. And this is where things start to get uncomfortable, because advice that worked beautifully in one era can quietly sabotage people in another. The problem isn't that paying off a mortgage feels wrong. The problem is that the feeling of relief gets mistaken for actual safety. Here's what almost no one talks about. When you aggressively pour every spare dollar into your house, you're not just reducing debt. You're converting flexible money into locked money. You're trading options for certainty. And that trade has consequences that don't show up until life throws a curveball. Picture this instead. You're in your 40s. You've done what you were told. You paid extra every month. You skipped vacations. You resisted lifestyle upgrades. And eventually, you send that final payment. The house is yours. It feels incredible. And then, not immediately, but quietly, something changes. A job loss, a health issue, an industry shift, something you didn't plan for, because no one ever really plans for those things. You open your bank account and realize something unsettling. You don't have much cash. Not because you were careless, but because you were responsible. Your wealth exists, but it's trapped in walls. And walls don't pay grocery bills. They don't fix cars. They don't cover insurance gaps. They just sit there, solid and unmoving, while life keeps asking for flexibility. This is where the idea of risk needs to be reframed. Most people define risk as owing money. I think that definition is outdated. Real risk isn't having a payment. Real risk is not having access. Access to cash. Access to time. Access to options. When you send extra money to the bank, that money is gone from your control. You don't get it back just because you need it. In theory, you can borrow against your home. In practice, banks only lend when you don't actually need the help. Liquidity disappears exactly when it matters most. And this is why so much advice sounds clean, but collapses under pressure. It assumes a stable life. It assumes income continues. It assumes calm decision-making. It assumes you'll never need flexibility more than certainty. But real life doesn't reward rigidity. Now, let's talk about the math. Without turning this into a lecture, when you pay extra on a low-interest mortgage, the return you're getting is the interest you don't have to pay. If your rate is 3 or 4%, that's your guaranteed return. That doesn't make it bad, but it does make it limited. Meanwhile, there are other places money can live. Places that grow faster over time. Places that stay liquid. Places that give you optionality instead of locking you into one outcome. Choosing to send extra money to the mortgage isn't neutral. It's a decision to accept a lower return in exchange for emotional relief. And that relief is real, but it's expensive. What makes this even harder is that paying off the house feels productive. It feels visible. You can point to it. You can say, I did this. Investing, on the other hand, feels abstract. The results take time. The progress isn't linear. And emotionally, it doesn't give you that same sense of closure. So people default to what feels good now, even if it quietly costs them later. There's another layer here that almost no one acknowledges. Inflation. When you lock in a fixed mortgage, something interesting happens over time. The payment stays the same, but the value of money doesn't. What feels heavy today feels lighter in 10 or 20 years, not because the loan changed, but because your income and prices around you did. In real terms, the debt shrinks on its own. Paying it off early short-circuits that process. You're choosing to repay with today's more valuable dollars instead of tomorrow's cheaper ones. Again, that doesn't make you irresponsible. It just means the emotional satisfaction is overriding the long-term math. And this is where financial advice often loses people. It frames decisions as moral, good versus bad, discipline versus reckless, instead of as trade-offs. Every decision has a cost, even the ones that feel responsible. Now here's the part that usually creates resistance. People will say, but I sleep better knowing I don't owe anyone. And that's real. Peace of mind matters. But peace of mind isn't just about eliminating payments. It's about knowing you can absorb a hit. Ask yourself this honestly. Who is more secure? The person with paid-off house and no cash cushion, or the person with a manageable mortgage and a year of living expenses sitting quietly in the background? Security isn't silence. It's resilience. And resilience comes from liquidity. There's also a psychological trap hiding inside the I'll invest once the house is paid off mindset. Life expands. Expenses grow to match available space. The money that was supposed to go toward building wealth often gets absorbed by comfort instead. Not because people are irresponsible, but because humans respond to what's visible. A freed-up payment feels like permission, and permission often leads to consumption, not compounding. Keeping a structure in place can actually protect long-term behavior. It creates boundaries that prevent lifestyle creep from swallowing progress. This is why so much financial advice fails in practice. It assumes people behave like spreadsheets. It assumes that removing a payment automatically creates discipline. It assumes future intentions survive real life. They often don't. None of this means that paying off a mortgage is always wrong. Context matters. Rates matter. Personal behavior matters. Emotional tolerance matters. If your interest rate is high, reducing it makes sense. If debt keeps you awake at night and leads to constant anxiety, the emotional cost might outweigh the mathematical benefit. But what doesn't work is treating one path as universally virtuous and the other as reckless. That kind of thinking creates guilt instead of clarity. The real shift happens when you stop asking, how do I get rid of this? And start asking, what gives me the most control over my future? Control isn't about owning things outright. It's about having options when life changes. It's about being able to say no, being able to wait, being able to absorb uncertainty without panic. And money at its best is supposed to buy you time and flexibility, not just a title deed. So what does this look like in practice without turning into extreme strategies or pressure? It looks like separating emotional comfort from structural strength. It looks like keeping enough liquid money that unexpected events don't immediately become emergencies. It looks like letting low-cost debt exist while your assets quietly grow elsewhere. It looks boring, and that's usually a good sign. You don't need to rush to zero to be safe. You need margin. You don't need to win the emotional argument. You need to win the long game. And maybe the most important part of all this is understanding that money decisions don't exist in isolation. They exist inside real lives with stress and fatigue and imperfect behavior. Advice that ignores that will always sound simple and fail in practice. Advice that respects human psychology might feel slower, but it actually works. If there's one thing I hope you take from this, it's that financial strength isn't about eliminating every obligation. It's about building a system that can handle disruption without collapsing. You don't need to be fearless. You just need to be flexible. And progress doesn't come from one dramatic decision. It comes from a series of calm, slightly boring choices that keep your options open. That kind of progress doesn't make headlines, but it does make life feel steadier. And in the end, that's what most people are actually chasing.